Hello everybody, welcome to JAIIB CAIIB English Medium channel. I hope all of you are doing fine. Today in this particular session, we will be talking about the most important PYQs which have been often repeated by the IIBF in IE and IFS exam. Since we have only limited time now for the exam preparation, now is the time to focus on the PYQs and start preparing for your practice sessions, because we are coming up with the marathon classes, we are coming up with the revision sessions on this particular channel only. So try to be very vigilant on this particular channel, because now in the last week, in this particular 2 or 3 days, you will be having some quality content delivered as always. So without any further delay, let's start our class with the first question in front of you. Which among the following do not fall under the provisions of the Banking Regulation Act 1949? So always remember, whenever we talk about the BRA, there are certain regulations, certain stipulations in the BRA, and all of the financial institutions, they are not covered under it. Fine. So the purview of BRA is limited. And when we talk about SCBs, the scheduled commercial banks, whether they are there, answer is yes, SCB finds special mention in the BRA. State cooperative banks also, same goes for the private banks. But when we talk about SCABs, that is State Cooperative Agriculture and Rural Development, that is not directly covered under the Banking Regulation Act, and that is the reason why we will take the option D as the right answer, because here it is written which of the following do not fall under the provisions of BRA. So D is the right answer here. Okay, so PACs and SCABs, these are the two particular financial entities which are not under the Banking Regulation Act 1949's purview. It is not mentioned there. When we talk about PACs, that is Primary Agricultural Credit Societies, they are at village levels, and the SCABs, that is State Cooperative Agriculture and Rural Development Banks, and along with that we have PCARDBS also, which are classified as Cooperative Credit Societies, and they are non-banks. Okay, since they are non-banks, they are not having any regulation under the BRA. Next we have the question which often being asked by the IIBF, that arrange the following institutions in the chronological order. Sometimes IIBF asks the question based on the organizations, like here it has asked. Sometimes it asks the questions based on the phases of economy. So chronological questions, they are highly important. And when we talk about this particular question, which among the following is the correct sequence of your establishment of DFIs, Development Financial Institutions? So DFIs, as everybody knows, they have a particular function of development in a country, and here we are given with 4 options. Always remember, IFSC is the first one. Fine. Whenever we talk about the DFIs, IFSC will find a special mention in the chronological order, because it was the first DFI, that is Industrial Finance Corporation of India. Second, we have what? Exim or IDBI. That is quite interesting. Fine. It will be quite close when we talk about the SIDB. So SIDB is just, you can say, it came out as an organization specifically designed for the small industries from IDBI. So after IDBI, you will be having SIDB. What will be the right answer? Try to answer this question. It's a simple question if you know the chronological order. Otherwise, you will find it difficult again. So here definitely the right answer will be what? Option B, 3, 1, 2, 4. First is IFSC, then we have the IDBI, after that we have Exim, and lastly SIDB. Next question, which among the following DFIs, Development Financial Institutions, is not a specialized financial institution? So we have some specialized institutions, some non-specialized institutions, some are not related to any special, you can say, area also. So Exim Bank, UTI, NABARD or TFCI. When I talk about NABARD, it is the refinancing agency, refinance organization, although it plays a crucial role in the rural banking, rural credit, but again, it is not performing that particular function like IDBI used to function. Exim Bank, supposedly one of the export-import bank in our country. UTI, if I tell you the exact full form of UTI, you can directly answer. So try to answer what is the right answer. DFI, not specialized financial institution, right? For the development only, but it is not having a specialized function. Correct answer is option B, that is UTI. So here you can see that we have various classifications pertaining to your DFIs. So DFIs, the discussion starts off from the development banks, and we have IFSC as one of the major development bank. It used to be one of the major development bank in the country. Then we have IDBI. Now though it is a full-fledged universal bank, but earlier it used to have one function only, that is rapid industrialization in the country. Then we have ICICI, again an example of a bank. Then SCICI, SIDBI, as I just told you in the previous question, that it came out from the IDBI only, specifically for your small industries. And NABFID, the most recent DFI out of all. Specialized FIs, they are Exim, NABARD, TFCI and TDICI. Fine. So the inculcation of NABARD was for the as a specialized FI. But when we talk about NABARD, it is having diverse relationship, it is having diverse function in the Indian economy. But for the examination, you have to remember that specialized FI, your NABARD and Exim are the prime examples. Then we have investment institutions. You have LIC and UTI here. UTI, the Unit Trust of India. When you talk about the mutual fund, you must be remembering that. Then we have state level institutions. We have SFCs and SIDCs. So this table, in fact every table in the syllabus, in the book, is very important. Direct questions have been asked till now, and we are expecting the same trend for the 2nd November exam as well. Next we talk about another question which is based on SHG. See, these are very simple questions, right? SHGs, or for that matter DFIs, then we have some banking law also, very simple questions. So module C is quite scoring as compared to module D and module B. Otherwise in module B you have to interpret the options. Here they are direct options. Which of the following statement with respect to SHGs, that is self-help group, is incorrect? So incorrect option you have to find, and not only incorrect but also you will learn some new facts about the SHGs from this question. Lending to SHGs constitute part of priority sector lending of the banks. That everybody knows that under weaker section category SHGs have been defined. Financing to SHGs by banks are refinanced up to an extent of 90% by NABARD. So always remember, NABARD is not having any kind of cap when it comes to refinancing any kind of activity, and it is indeed 100%. Fine. So this is a wrong statement. SHG is having one of the bank linkage program thanks to NABARD only. It is one of the flagship, or you can say hit project of NABARD. Then advances to SHGs are included as part of lending to the weaker section, that I have already told you in the first statement itself. Loans to SHGs are provided collateral free. No collateral is required because these are small loans. Although various tranche are there, tranche 1, 2, 3, 4. But when we talk about the initial loan, it is very small amount. Fine. So the right answer will be your option B. Fine. You have to tell the incorrect statement. B is incorrect statement. 90%. No, it is 100%. Then we have, which among the following is the not salient features of your amendments made to Chapter 3B of the RBI Act in 1997 under the regulatory oversight of NBFCs. So always remember, NBFCs, they are having some setup with them which is different from the regular banking industry, and that is what is written here, that is what is asked here, that you have to tell the you have to select a particular option which is having some salient features which are not a part of the amendment which happened in the Chapter 3B of RBI Act. So specific question is asked, fine, specifically for the RBI Act. Making it mandatory for NBFC to obtain the certificate of registration COR from RBI. So whether certificate of registration is required by the NBFC or not, if you know that, it is a very easy question. Making it mandatory for NBFCs to maintain minimum level of net own fund. All of us know that NOF criteria has been increased to 10 crore initially. Then requiring all NBFCs to create a reserve fund and to transfer a sum which is not less than 10% of their profits every year. So profit maximization should be a role in the NBFC's business. But when you talk about the transfer of funds, whether it happens or not, empowering RBI to file winding up petitions against NBFCs. So RBI can file petition against n number of financial organizations, financial institutions, but whether that is replicated in chapter 3b, a specific question is there. Fine. So the right answer for this question is option C, that is requiring all NBFCs to create the fund and to transfer a sum which is not less than 10% of the profit every year. This particular point is not a salient feature of the amendment of chapter 3b, which pertains to NBFCs only. Then we have a question on NOF. I think we have covered this question in the last lecture also, because this is one of the most important questions picked up from the previous year exam. The regulatory minimum NOF, that is your minimum net on fund, for NBFC, ICC, NBFC, MFI, NBFC factors shall be increased to dash as per the scale based regulation. Just now we have discussed that it has been increased to 10 crore by 2027. That's what we were discussing just now. Right? So correct answer will be what? Option A. Here you can see that the scale based regulation SBR talks about 10 crore limit by March 31st, 2027. As I have told you in the previous lecture also, in the previous sessions also, that this question can be asked directly. Why? Because RBI has amended n number of provisions of NBFCs pertaining to SBR this year only, this financial only in fact. Then we have LIC, one question on LIC. It was established in which among the following phases of financial reforms in India? So phase 1, 2, 3 or 4. Again a repeated question, 3 times this question has been asked. Correct answer is phase 2. And phase 2 is what? It is between 1947 to 1991. Other phases being pre-independence prior to 1947, post-liberalization 91 to 2010, post-global financial crisis is 2010 and onwards till today. Fine. Now let's have one question on the PJ Nayak committee. Committee based questions are very important. Try to answer this question and try to answer it within 1 minute. Okay, that should be the time frame for these statement based questions. Only 4 statements are there. You can easily solve it. So what will be the right answer here when we talk about the PJ Nayak committee? See, one by one, let's observe the statements. To look into various problems related to bank boards, such as standards of specification, policy, legal, etc., and to suggest measures to be taken. So, policy regulation, or for that matter, if you have the specifications for the legal aspects also, whether these problems were taken up by the PJ Nayak committee or not. Bank board, everybody knows. To examine the working of bank boards, issues of strategy, growth, governance and risk management in banks. To review the RBI guidelines on government ownership in the banks. So, although when we talk about the economic reforms, 4 committees, the most important committees were there. PJ Nayak was also one of the most important committee. But whether this committee gave the recommendation that yes, you should review the RBI's guidelines on government ownership in banks or not. Then we have to analyze the work, conflict of interest and independence in the bank boards and make suggestions towards the same. So conflict of interest, whenever it happens in the bank boards, it should be dealt by the you can say intervention of RBI. But when we talk about PJ Nayak committee, whether it recommended this or not, so correct answer will be what? Option D, that is all of these were the recommendation of PJ Nayak committee, specifically bank board. Everything related to bank board, at least in our syllabus, it is being talked by the PJ Nayak committee. Then we have the paid up capital for establishing scheduled banks in India must be at least dash. What should be the minimum paid up capital? See here it is not asked that maximum, only the minimum, no range, only the minimum capital. And such questions are quite tricky. Why I am saying these are tricky? While sitting in the examination you will find such questions quite tricky. Reason being, in our mind we have n number of data points. Do not get bogged down by that situation, just focus on the keywords. Like here, paid up capital is asked. Right? What is the paid up capital? Simply stated, it is 5 lakh. So A will be the right answer. Next, we have a question on the call notice money market. When we talk about the various regulatory measures taken by the RBI, how the things will pan out. Considering the regulatory oversight by the RBI and the differing participation rules for various entities in the call or notice money market. There is term money market also, but here call or notice money market is mentioned. Which of the following scenarios is the most likely to occur within this particular money market? So we have various scenarios. First one, newly established RRB is there with the temporary surplus funds actively borrowing call money from the large insurance company facing short-term liquidity constraint. So two things here. One is whether it is on the collateralized basis or uncollateralized basis, and what will be the time duration. For long term we have one type of money market, for mid term another, and for you can say very small term we have another money market type. So newly established RRBs need temporary surplus funds actively borrowing call money. Actually it is investing indirectly from the large insurance company. Then we have PD, the primary dealer with temporary shortage of funds, borrowing notice money on the collateralized basis from the development finance institution, the DFI, and seeking to deploy its excess liquidity. So whenever we have the excess liquidity in the market, it should be absorbed. And how you can absorb? Like RBI absorbs it via its own monetary policy. Similar is the case with your primary dealer. They are also being assigned by such tasks. But whether the call or notice money market has this setup with the collateralized based or uncollateralized based, that you should remember. A scheduled commercial bank excluding RRBs lending call money on an uncollateralized base to another scheduled commercial bank experiencing a temporary mismatch in CRR maintenance. So temporary mismatch in CRR maintenance, it will have some you can say regulatory aspects from the RBI fund. It will be having some regulatory compliances from the RBI because CRR is maintained with the RBI only. A select mutual fund having received significant overnight inflows lending notice money to a primary dealer looking to cover its underwriting commitments for a government securities auction. So primary dealer, two options are for the primary dealers. One option specifically talks about the RRB and another option is talking about the scheduled commercial bank. What is the right answer here? See, this type of question you will see in the examination, and these type of questions are only because of them only you will say that IFS is one of the most tricky subject, right? Because of the statement based question, because of the term that you have to select the most appropriate answer. Right? Somebody will say that B is the right answer, some will come and say that C is the most appropriate answer, but in actual, let me just tell you, the most apt reply to this question will be option C only. Fine, it is C only, and yes, C is the right answer. Why I am saying this? See, scheduled commercial bank, you have excluded RRBs, they are lending call money on a uncollateralized basis. That is the most appropriate definition. To another scheduled commercial bank, they are experiencing temporary mismatch in the CRR. For this particular case, you will have the regulatory oversight by the RBI. And whenever we talk about the most appropriate answer, it might differ from person to person how they interpret, but how we should interpret so that we have maximum chances of making, or you can say scoring marks, you should go by the norms given in your syllabus. That is it, right? So C is the right answer for this question. Here you can see when we talk about the question itself, one by one, let's try to figure out why C is correct. Considering the regulatory oversight by the Reserve Bank of India and the differing participation rules for various entities in the call or notice money market, right? For participation, we have different rules in different markets. Which of the following scenario is the most likely to occur within this particular money market? One by one, let's see why they are wrong. So first statement is explicit. It explicitly excludes the RRBs from participating as both lenders and borrowers in the call or notice money market. Insurance companies can only act as a lender. And always remember, insurance companies can act only as lender, not as a borrower. That is why first statement was wrong. Then we have uncollateralized basis. There it was written in option B, collateralized basis. That is why it is wrong. Why C was correct? Because banks often use the call money market for short-term adjustment. That's what I told you in the beginning itself, that you must remember two things: whether the particular scenario is for the short-term, long-term or mid-term. Secondly, what you should remember is whether it is for collateralized or uncollateralized basis. That's it. So the text indicates that scheduled commercial banks can operate as both lenders as well as borrowers. So insurance companies, they can act only as lenders, but when we talk about the SCBs, the scheduled commercial banks, they can act as both. Banks often use the call money market for short-term adjustments to their liquidity, including CRR maintenance, and the lending is typically uncollateralized. Whether it is collateralized or uncollateralized, always remember, in the call money market it is uncollateralized. The last statement, when you talk about the primary dealers, while select mutual funds can participate as lenders in the call or notice money market, when we talk about the primary dealers, typically borrow funds from them for underwriting commitments in this very short-term market, only for the underwriting commitments. Banks are more likely counterparties for the primary dealers. So always remember, mutual funds and primary dealers, they can go hand in hand, but mostly we have seen that primary dealers are having direct association with the banks. Okay, so I hope that this question is clear, because ultimately module D, or you can say module C also somewhere down the line, they are not difficult, but the statements make them very difficult to answer. Then we have the applicant to become a tri-party agent should have minimum paid up equity share capital of what? So we have seen the paid up capital 5 lakh. Here it is written that you have to tell the tri-party agent want to become the applicant want to become tri-party agent, what should be the minimum paid up equity share. So it will be what? 25 crore. Fine. So these numbers also you have to remember, the applicant's eligibility criteria as TPA, as primary dealer, or for that matter when we talk about the third party agent, fine, tri-party agents also. Okay. So the applicant should have a minimum paid up equity share capital of 25 crore. When we talk about scheduled commercial banks, recognized stock exchanges and clearing corporations of stock exchanges, or the clearing corporations authorized under the Payment and Settlement System PSS Act, they are eligible to become tri-party agent. This question can also be asked in the exam, that which of the following are eligible to become the tri-party agent. So always remember, SCBs, then recognized stock exchanges, clearing corporations of stock exchanges and clearing corporations authorized under the PSS, they are eligible to become the tri-party agent. Next we have applicant, they must have 25 crore as the minimum paid up equity share capital. The applicant should have past experience of at least 5 years in the financial sector in India or abroad, preferably in custody, clearing or settlement services. So specific services must also be seen while granting the you can say while granting the final heads up for a particular party or applicant to become the TPA. Next we have term money market, a very important question. Call notice we have seen. Now let's see one question on the term money market. Whenever we see such type of question, money market, what you will be thinking in your mind? Two things: whether it is short, mid or large, long term. Second, collateralized, uncollateralized. That is it. So which one of the following statement is correct with respect to the term money market, the TMM? So term money refers to borrowing or lending of funds for a period exceeding 14 days and up to 1 year on an uncollateralized basis. That is what is right. Okay. So correct statement, the first statement I think itself is correct. Term money refers to borrowing lending of funds for a period exceeding 14 days and up to 1 year. So A will be the right answer here. Okay, yes. Now let's see some explanation also. When we talk about the call, notice or term money market, this is a market for trading very short-term liquid financial assets. Short-term funding will be there, short-term trading will be there, that are readily convertible into cash at low cost. Why this is preferred? Because of the low cost involved. An institution which has surplus funds may lend them on an uncollateralized basis. No collateral is required to an institution which is short of funds. Like we have seen in the previous question that whether the insurance company can lend to the RRBs, or for that matter scheduled commercial banks can lend to the other SCB or not. So which type of transaction is ongoing? So basically an institution which is having surplus funds lend to the particular another party on the uncollateralized basis, and that is when it is experiencing the shortage of funds. Period of lending may be for a period of 1 day. So for 1 day we have call money, that is the shortest time period, 1 day call money. Between 2 and 14 days you will have the notice money. And when we talk about the term money, it refers to borrowing lending of funds for a period exceeding 14 days up to 1 year. So up to 1 year, that is short term. When we exceed the figure of 1 year, we fall, or we say that the particular transaction falls into which category? Into the long term lending category. Okay, that is why it is written short term liquid financial asset, and correct answer for this question is option A. Okay, so I hope you will remember this: call money, notice money, and your term money. How they are different? Time period 1 year, 1 day is for the call money, 2 to 14 days notice money, and when we talk about the term money, it is 14 days to 1 year. Fine. Next we have question based on the factor system. See, this factor system is again very important. Question on regular basis is asked from factoring, or for that matter forfeiting. So here we have a question where the examiner says import factor's role in international factoring is typically contingent upon a specific event related to the buyer's payment. So we have the particular scenario where we are talking about the buyer's payment, right? That somebody has bought something and now you have to pay, the buyer will pay it to the particular party. Which factoring system triggers the import factor's involvement only upon when the buyer defaults? Buyer has bought something and now the buyer will be paying, but just in case the buyer fails to pay, who will chip in and complete the transaction? That is the question, simple question. So when you will have the involvement of import factors, and under which system it is, whether it is in the single factor system, double factor system, direct import factor system, or triple factor system. Simply stated, such kind of setup is in the single factor system, that is option A. How? Now see, single factor system, how you can elaborate here. So this type of factoring, it is for a single factor. Fine, there will be a single factor only. In this type of factoring, import factor comes into focus only if the buyer defaults in making the payment. This import factor has only one role, or its role will be triggered only when the buyer defaults. Otherwise, there is no role whatsoever. In such cases, the export factor recovers the amount from the import factor, and it is then left to import factor, who has provided the money to the export factor, to recover the factored amount from the buyer. Now import factor will be sending notices to the buyer. Figure systematically shows this type of factoring arrangement. So always remember, in the single factor system, what is happening? You only have import factor with one particular condition, that if the buyer defaults, the import factor will chip in and provide the funds to the export factor, and after the settlement is done, import factor will try to recover from the buyer. So first step will be what? It will be the factoring arrangement, factoring agreement, right? The export factor and supplier will be having the factoring agreement. Then we have delivery of goods. Supplier will provide the delivery to your buyer, right? Delivery will be provided. Assignment of accounts receivable will be done by the supplier to the export factor, because ultimately export factor is there to recover the final amount for the supplier. Then we have the fourth point, funding to the supplier by export factor. Export factor will provide the funding to the supplier and the supplier will have a sigh of relief. Okay, otherwise if no factoring was involved and the buyer was defaulter, then the supplier will be having certain losses in the business. Payment by the buyers to the export factor will happen. So buyer will provide the payment to the export factor. That is how the normal functioning happens. But in single factor, what will happen? If just in case the buyer defaults here in the fifth stage or the step, if there is default in the form of buyer's non-commitment, then import factor will initiate the overall transaction. In case buyer does not pay in 90 days, the import factor pays to the export factor. And if 0.6 materializes, fine, the export factor now has the money in the form of the transaction provided or initiated by the import factor. Import factor recovers the amount from the buyer. Now import factor will go to buyer and try to recover. It is an uphill task, but again there will be some try from the side of import factor. Okay, so this was it for your single factor system. Now let's have a question on NAV. So the net asset value of equity mutual funds and index or debt mutual funds are required to be rounded off to how many decimal places respectively. So we have some of the decimal places mentioned in the book also while studying the mutual funds chapter. So when we talk about the equity mutual fund, what will be the decimal places, round off decimal places, and what about the index or the debt mutual fund? Direct question is there. So the decimal place for your equity mutual fund will be 4 and index or debt mutual fund will be round off to 2, right? 2 decimal places, DES 4 and 2. Fine. So to ensure uniformity, mutual fund have to be rounded off, have to round off the NAV up to 4 decimal places for your index funds and all types of debt and liquidity or money market schemes. For all the equity oriented and balanced fund scheme, the fund houses are required to round off the NAV up to 2 decimal places. So always remember, when I talk about the mutual funds, 4 decimal places is for your index funds and the debt funds, fine, debt funds as we call them. For debt or the liquid or for that matter index funds, it is 4 decimal places. For your equity or the balanced funds, it is 2 decimal places only. Such type of simple questions can be asked in the form of 0.5 marker as well. Now we have a question based on the principle of indemnity. The principle of indemnity, it is one of the important concept. Why I am saying this? Because somewhere down the line, whenever we talk about the numericals from module D, there are 2 topics only. Largely there are 2 topics. First is your mutual funds. From there NAV type of question can be asked. You can say final earning of the particular buyer or the investor in the mutual fund using the appropriation method can be asked. Then we have the second topic as insurance. In insurance, the penetration can be asked like it was asked in the previous exam cycle. Then we have one question which can be asked for your in your insurance topic. It is related to the principle of indemnity, the loss. What will be the loss, or for that matter, what will be the coverage will be provided. So Miss Priya owns a boutique that she established 2 years ago, right? 2 years ago, with an initial investment of 20 lakh. 20 lakh is the initial investment. She purchased the standard fire insurance policy with the sum insured of 15 lakhs. 15 lakh is the, you can say, standard fire insurance policies amount. Recently, fire damaged her boutique, resulting in the actual loss assessed at 18 lakh. According to the principle of indemnity, maximum amount of compensation Miss Priya can expect from the insurance company is what? Whether it is 18 lakh, 20 lakh, 15 lakh or none of the above. So when we talk about principle of indemnity, there are three things which we must know for actual formula. That is, what is the value of the asset insured. So here the value of the asset was 20 lakh. Value of the asset 20 lakh. Then we have the policy. The sum insured is 15 lakh. After that, we also have the actual loss. So what is the actual loss? It is 18 lakh. These three things are provided to you in the question. And what is asked? You have to tell that what is the maximum amount of compensation. Miss Priya will get what amount as the compensation. The right answer will be what? It is for this 15, it will multiply by 20. So it will be 13.50. Yes. Yes. So none of the above will be the right answer. 18, 20, 15. No. D is the right answer here. Yes, D is correct. When we talk about the formula, you can see that 15 divided by 20 multiplied by 18. 15 was what? It was the sum insured divided by the value of the insured asset, the initial investment 20 lakh of the boutique, multiplied by the actual loss. So the compensation which Miss Priya will get is 13.50 lakhs. That will be the correct answer. Okay. Then we have a question based on the REIT. Which type of real estate investment trust is specifically required to invest a minimum of 24% of its assets in commercial properties like shopping malls? So whether it is residential REIT, healthcare, retail or office REIT. So the correct answer for this question will be, when you talk about shopping malls, they are for what? They are for the retail purchases. C will be the right answer. Okay. Even if you do not know that what is the actual meaning of REITs or retail REITs, just try to simplify the question based on the options given. Just try to eliminate them. So here we have the REIT, real estate investment trust. They are the investment vehicles that pool investor money like mutual funds and use them to buy a portfolio of real estate assets. Based on the sectors in which they are operating, there are 5 different types of REITs. I mean, 5 different types of REITs are there. But the most important ones are retail, office and mortgage. So retail REITs, these are required to invest at least 24% of their assets into commercial retail such as shopping malls and freestanding retail stores. For the office REITs, these are primarily to invest in and operate office spaces. Directly, the you can say type of REIT tells us that what will be the right answer. Their main source of income for this type of REIT is thus the rental received from tenants under the long-term lease arrangements. Mortgage REITs, in the case of these REITs, estimated 10% of investments are to be made into mortgage instead of physical real estate. So always remember, 10% of the investment they are into the mortgage. That is why it is known as mortgage REIT. Retail REIT, at least 24% of the asset into the commercial retail like the shopping complexes. Okay, now you must be seeing that there are some repeated questions from the session of 50 marks in 50 minutes, 50 questions in 50 minutes. Why? Because these questions have been repeated in the previous years as well. That is why we have picked them here in this session also. But do not worry, we will be covering other questions also, because since this is just the first part, right? In which among the following cases insurance ombudsman cannot take up the case? So insurance ombudsman, always remember, it is there for like there is ombudsman in the RBI, for the banking sector, for insurance also we have insurance ombudsman. So they cannot take up the case when the complainant has made a representation to the concerned insurance company and the insurer has accepted. So if the insurer has already accepted, why somebody will approach the ombudsman? Still, if they are approaching ombudsman, you cannot file a case with the same. The complaint is made later than 1 year after the insurer had replied. So if after 1 year the complaint is made, the particular case has lapsed in case of your insurance ombudsman. This is also wrong. You cannot take up the case there. The same complaint is pending in any other court, be it the civil court or some other court. So again, if it is already ongoing in some other court, then definitely you cannot go with that in the insurance ombudsman. So the right answer will be what? It will be option D, 1, 2 and 3. In all the 3 cases, you cannot move to the insurance ombudsman. Fine. Here some important things are to be discussed. So the insurance industry has the ombudsman across the country. Each ombudsman is empowered to redress the customer grievances in respect of insurance contracts on personal lives, where the award compensation not exceeding rupees 30 lakh, including the relevant expenses if any, before lodging a complaint with the ombudsman. Fine. So always remember, whenever you talk about the insurance ombudsman scheme, you have a particular number there. Earlier it was 30 lakh, now it has been improved upon to up to 50 lakh. Okay. This is mentioned in your book, but now it is 50 lakh. The complainant should have made a representation to the concerned insurance company. Insurer either should have rejected. If they have not rejected, you cannot just go to the insurance ombudsman. The complaint and no reply is received by the complainant within a period of 1 month. Okay, 1 month is the criteria, not 1 year. After 1 year, you say that yes, now let's just reopen the case with the insurance ombudsman. Not possible. After the complaint is received by the insurer or the reply is not satisfactory. Okay, the complaint is not made later than 1 year after the insurer had replied. If the insurer had replied, then what? 1 year has lapsed, then can you go to the insurance ombudsman? Again, answer is no. The same complaint should not be pending in a court, consumer forum or before any arbitrator. Who is arbitrator? A particular entity, organization who is there to resolve the disputes. Okay, that is the meaning of arbitrator. Fine. So insurance ombudsman scheme, I hope everybody will remember, along with the important facts of the same. Okay, so this was it for today's class. This was the first part. We will be coming up with more parts in the upcoming days because the exam will be on 2nd of November. So we'll be covering the entire file of your previous year questions. And when we talk about right now what you should do as an aspirant, you must focus on revising whatever you have read. Nothing new should be touched upon. Secondly, you must be very sure in your mind that in these last 3 odd days, I will try to solve at least one full length mock test. That should be ensured at your end. And in order to help you out in that also, we have launched a free test for 30th, 31st and 1st November on the ADA 247 platform. Fine. So on our application you can directly visit, and there you can find the link to the test, and after you click on the registration link, you will be registered, and as soon as the test window opens up, you should attempt it in real time. Okay, that is the ask. And when we talk about the website, how you can go through the website and through our website ADA 247 and go to the mock test. See all courses. We have JAIIB CAIIB. Then in the JAIIB CAIIB you will be having, if you have already the courses from our side, directly log in to JAIIB November 2025. In the mock test category you will find that. If you directly want to assess that particular test, then scroll down and you will find the examination. Just a moment. First of all, log in from here. Once you log in, you will be having the explore test option, and in this particular category you will find JAIIB CAIIB as well. Okay, the link of the tests, they are shared in the description also of this particular video. You can directly go to that link as well. Right now I have to log in, that is why I cannot show you directly, but yes, that's how you can enroll in the course. When I type here, let's just try to see JAIIB IE IFS. So here, once you scroll down, so right now it is not there because I have not logged in, but for your reference we have included the link in the description box where you can just click and you will be redirected to the portal from where you can access the test. Okay, so there are 3 tests. Again I am telling you, 30th, 31st October and 1st of November you will be having test. If you have any doubt regarding the test, or for that matter any course of ours, you can directly contact us on the number 0981 981 9247. This is the number where you can call us and we will resolve all your queries as soon as possible. Okay, so this was it for today's class. If you have any doubt regarding the questions which we have discussed in this session, feel free to ask me in the comment section. Also, if you can, then tell me your scores also from this particular session. We'll see you tomorrow with the second part of this particular PYQ series. Till then, goodbye everybody, take care.